Well, let's get to our market panel. Joining us now is 248 Ventures Chief Strategist Lindsey Bell and Citi Global Chief Economist Nathan Sheets. Guys, happy Friday. Nathan, going back to the jobs report this morning, doesn't this take 6 cuts off the table or no? Is that what the market was in part trying to digest?
I think today's data overall were very much a mixed bag. Yeah, you got a bit of an upside surprise on the payrolls numbers, but it still paints a picture of a gradually slowing economy. Maybe a little bit of wage pressure that the Fed's going to want to keep its eyes on, but on balance, an easing labor market. And then that was reinforced by the services ISM, which was quite soft, probably influenced to some extent by seasonal adjustment issues. But if you entered the week thinking the Fed was going to cut in March, I think you can leave the week with that same view. My personal perspective is wait and see. I kind of expect them later in the year, maybe later in the second quarter, but nothing to really move the dial today or during the past week.
Lindsey, you think the Fed cuts in March and 6 cuts are even possible?
I don't see 6 cuts, but I think there's a lot of moving parts that you have to take into consideration. I think a March cut is really going to be predicated on what happens with inflation, and we get 3 inflation readings, the first of which comes next week before that March meeting. So I think there's a lot of data that we need to digest. The Fed needs to digest. They're going to continue to be data dependent before making any decisions. But I do think that the minutes that we got from the Fed this week from their December meeting show a Fed that is, while they believe rates may have peaked, they don't necessarily want, to me, they took the March cut off the table in those minutes. So Chair Powell was pretty dovish in the press conference after that December meeting, but these minutes were much more hawkish. And I think that's what investors grappled with all week was mixed messages, even contracting messages from lots of different data points this week.
Yeah, which, by the way, the market has been wrong before. It's that old mantra in some ways, Nathan, of don't fight the Fed. The other piece of this puzzle, though, and certainly one that, there's skepticism surrounding, is the consensus estimates for 12% S&P 500 earnings growth this year. Is that too lofty?
Well, I never want to count U.S. corporates out, but by the same token, that is very rapid earnings growth in a macro environment that is likely to be lackluster. It is consistent. What we're seeing is consistent with a soft landing, but that means slower nominal GDP growth. And I think that will take a bite out of those earnings from the corporate sector.
Lindsey, it sounds like you had thoughts on this too.
Yeah, no, when I think about that 11%, 12% estimate, depending on what estimate you're looking at for a consensus, it sounds rosy. Sure, it's above the historical average rate of about 8 to 10%. But we're coming off of a year where earnings are basically going to be flat to down slightly in 2023. So that's a nice rebound that we're expected to see. Comparisons are much easier. And of course, we're going to see sales slow into the year ahead, but probably to a more normal range. And so I think a normal earnings growth rate of 10 to 12% is quite doable this year. Of course, I think we're in a show me year, and part of that show me is going to be about GDP growth coming in better than perhaps the Fed or the consensus expects, which is pretty weak versus historical averages, and really seeing that come in better than expected, and then therefore earnings being able to come in better than expected.